to Conversations with Frank Fabozzi. I'm Frank Fabozzi. The CFA Institute Research and Policy Center brings this series to you. My guest today is Jason Zweig, who is a prominent financial journalist, best known for his long-running column, The Intelligent Investor, which appears in the Wall Street Journal. He's one of the most respected financial writers in the U.S. His writings focus on behavioral finance, investor psychology, and long-term investing. He has the gift of taking the most complex principles in finance or concepts and making them understandable to a wide range of investors. He previously was a senior writer at Money Magazine, a guest columnist at Time and CNN.com, mutual funds editor at Forbes. I hope I got this all right. In addition to his updating The Intelligent Investor, he co-authored about 18 years ago, a book, Your Money and Your Brain. It was a groundbreaking book on neuroeconomics and behavioral finance, explaining how the brain reacts to financial decision-making and why investors often behave irrationally. He wrote The Devil's Financial Dictionary, fun dictionary reader, a satirical but insightful dictionary that defines financial terms with wit and skepticism. For example, an auditor as an accountant all too often may approve a company's financial statements exactly as the company's management wishes them to be presented. I'm not too sure that was satirical. Well, a bull is a person who believes that an asset will go up in price. A belief often based exclusively on the fact that the person owns it, happens to own it. One more, a go anywhere fund is a mutual fund specializing in stocks or a wider range of assets that can lose money in every imaginable way, and then some. And he even gives you, whether it's a noun or a verb, part of the grammar. So it's fun. I think it's about $10 and $9 a book. Okay. He graduated from Columbia University, where he studied classical languages and philosophy, and never took a course in finance. And that background actually gives his writings a distinctive and humanistic and skeptical tone. Welcome, Jason.
Great to be with you, Frank, and thanks for the effusive introduction.
Wow, it was a lot of fun to write. How did you first become interested in financial journalism, and what led you to focus on personal finance and investing, particularly your undergraduate background?
Yeah, so the short answer would be serendipity. It was just luck. I've ever since I was about 13 years old, I've wanted to be a writer, but initially I wanted to do creative writing, fiction, short stories, poetry, whatever. But, my great American novel wasn't writing itself, and I was really struggling to find my way and, sort of almost against my own inclinations, I kind of stumbled into journalism. First, I worked at a small Africa magazine. Then, through sheer dumb luck, I got a bottom rung job at Time magazine. And then they cut back on their staff, and I landed at Forbes. And the next thing I knew, I was a financial journalist. And after about 3 days, I realized I loved it, because I quickly felt that I quickly understood that when you explore money and investing, you're really delving into human nature. And, we all live in a world in which it seems, or maybe we pretend, that the markets and investing are about numbers, but they're really about emotions. And I just immediately took to it.
What is your own approach to investing? Do you follow the principles that you write about, or have you adapted a unique strategy over time that you don't want to share with anyone?
Well, no, I don't have any secrets. I'm an open book. I mean, I think like most journalists who work at respectable news organizations, my investing strategy is extremely uninteresting because that's kind of a professional requirement. At the Wall Street Journal, we have a very strict um, code of conduct, and it puts very tight limitations on our ability to trade in and out of the market. And long ago, decades ago, I decided that I would just have all my money in index funds, which remains the case. Um, for many years, I was a relentless dollar cost averager. Um, but, uh, I'm getting old, so now I'm approaching the decumulation phase, so I no longer do that. But essentially, I just have a portfolio that consists exclusively of index funds and, TIPS, Treasury inflation protected securities, most of which I hold in a TIPS ladder. Uh so that, I own the individual underlying securities.
Right. So the code at the Wall Street Journal is similar to what they have for Congress, right? For is that right?
Um, I I you're really hitting me where I live, Frank. In 2010, I wrote a series of columns, uh sort of exposing all the crazy, um, trading that was going on Capitol Hill, and, that sort of indirectly led to a feature that was on 60 Minutes, and ultimately we got the Stock Act, which supposedly restricts trading by members of Congress. But of course, Congress writes its own code of conduct, and the trading is still going on, and I still think it's disgraceful.
Yeah. Well, I was going to write I've written, but I've buried what I think is an interesting piece using economic theory about uh, how we should chastise uh, high school guidance counselors and college counselors on not sharing with students the best route to become wealthy is not becoming a successful entrepreneur, becoming a CFO of a major company, or becoming a hedge fund manager is getting elected to Congress. But that's a different story. Okay. So, are there
Yep.
any personal habits or routines you believe have contributed to your success in a field that actually requires constant learning and adaptation? I mean, I'm
Yeah.
sure you're not in the I know everything mode.
Yeah. No, I try not to be. One of the I will say one of the great things about being an investing columnist for the Wall Street Journal is it's ve it's very hard to be sustainably wrong about stuff, um, because uh I mean, the journal has millions of readers, and, there's hundreds of thousands of people who uh, have like directly signed up to receive my column. You can get it by email or there's a newsletter. And um, if I mess up, I hear about it. And I hear about it really fast and very bluntly. Um, so, you know, I really think that setting up some kind of feedback mechanism is incredibly important for people. And, it can be difficult in it can be a little difficult, I think, in the money management business, for example, to get frank feedback. Now, of course, you're getting feedback from the markets every day, but it's noisy feedback. It's bad feedback. You know, you you buy a security for 10, it goes to 11. Well, you just quote learned that you made the right decision, but the next day it might go to 8, well, have you learned you made the wrong decision? I mean, it's very the feedback is noisy. So, it might be helpful to have a devil's advocate on staff. Um, some people try what they call red teams, which are sort of oppositional to each other's ideas. Um, you know, Being open to being wrong is, I think, the single most powerful tool in learning and becoming better at what you do. And, if we have a minute, I'll tell a quick anecdote. When I was a very young reporter at Forbes magazine, you know, uh, pretty much a generation ago, I got a really rude letter from a reader, uh, sort of ripping apart one of my articles. Uh, and I answered in this there, as at the Journal, when you get a letter or an email or a phone call saying that something was factually inaccurate, you have to respond. That's one of our principles in good financial journalism. And so I wrote a letter in response, and all the letters had to be approved by the managing editor. And he showed up in my cubicle and he said, "What is this?" And he was holding the printout of my letter. And I said, "Oh, that's a letter to that guy who said I was wrong." And um, and I described the reader with I was blunt. I used an anatomical description. Um, and the managing editor repeated it and said, "Well, that blankety blank, he pays your salary. Now answer him and act like it." And it was a fabulous lesson for me because I immediately took that lesson to heart, and I said, "Well, the guy does pay my salary even if he's a jerk." And I went back through my response and I took it to zero, and I said, "Let me just erase everything from my mind and start over and try to look at his objections as fairly and neutrally as I can." And I wrote a completely different letter. And ever since, I've always tried to respond to people who say I'm wrong. The starting point in my answer is always maybe they're right. And, uh, instead of trying to prove that they're wrong, I try to prove that I'm wrong, and then I answer them.
Well, let's think about why you might be wrong. There are facts. Let's say you're describing a concept or a company or an asset management firm, and you can make incorrect statements about that company. That's one thing. That's sort of very easy to deal with in terms of you made a mistake. Then there are opinions
Mhm.
that you might give based on some arguments that you might have.
Yep.
And so the only thing someone can argue about is, whether the foundations that you built it on may be wrong.
Mhm.
Then there's predictions that you might make
Mhm.
about whether, but you don't really often make predictions about the movements, right? I mean, you qualify them, but if you had to be right all the time on those predictions, you'd own the Wall Street Journal. You would be an employee, and the
Yeah.
managing editor who told you that would be your employee.
Yeah,
Okay.
that's correct.
I mean, I get that often when people ask me, "Well, what do you think?" I say, "Well, listen, if I knew for certain, uh, you're my friend. How much money do you need? I just sort of go into the market and make it and give it to you." I mean, so it's really very difficult. That last type of thing is, no one expects perfection in predicting. Okay. Well, let me ask you something. What's the most significant changes you've seen in financial journalism than getting quick responses to statements that you might make and people disagree with?
Well, I think the most significant development is, the I guess I would say the hollowing out and the flattening of news and information and advice. And, decades ago when I was a young reporter at Forbes, if you were an individual investor, and frankly, if you were a professional investor, uh, you had very few sources of information. Um, there were the companies themselves. Uh, you know, uh, there were SEC filings, but of course, if you wanted an SEC filing, you either had to go to a regional office of the SEC to obtain a printout of a company filing. You had to get it from the company itself, a public library, or you had to pay for a third-party service that would provide it. And, there were 4 or 5, maybe half a dozen reputable publications, the Wall Street Journal, Barron's, Forbes, Fortune, maybe a couple others. The Financial Times didn't have much of a presence in the US then. Bloomberg didn't exist. Um, and um, Today, there are thousands, maybe even millions of sources of information. But what's authoritative and what's objective and uh, not rife with conflict can be very difficult for people to sort out. So, I mean, I think that's the biggest change. Is the Wall Street Journal, for example, any less authoritative than it was, 10, 20, 30, 50 years ago? I don't think so. And I would say the same for the best of the major financial news organizations. But we now compete, with blogs, we compete with social media, we compete with, you know, uh, 25-year-old kids living in mom's basement.
Well, here's something you do great. How do you balance reporting complex financial concepts in a way accessible to a general audience? I mean, you have people, people reading your column who uh, attended MIT, and some people who can't spell MIT.
Yeah,
Okay, Ha- that was one I got from Sylvester Stallone.
yes,
Ha-
that's pretty good.
yeah. Do you have a specific approach? And
Yeah,
by the way, I think one of the advantages you have is you didn't take finance courses.
yeah, and I would absolutely agree with that, Frank, because um, you know, the economics and finance I've learned and the investing theory I've learned, has all come through osmosis, through, reading thousands of articles in, for example, the FHA or the Journal of Finance and, hundreds of books and interviewing thousands of people over the years and just like sponging it all up. I'm self-taught and maybe I should, maybe some people would say I should be embarrassed by that, but I'm not. Um, I have a very specific reader in mind when I write. I write for my high school English teacher's wife. Um, my high school English teacher and his wife are my lifelong friends ever since I entered high school. Um, and she's very bright. She's super intelligent, very well educated, but she knows almost nothing about finance and investing. And um, uh, did, I don't know, 15 or 20 years ago, I was at their house and she said, "Oh, I read a column of yours and I really liked it." And then she paused and she said, "But I didn't understand any of it." And and I said, "Well, you've just given me a challenge because my challenge for the rest of my career is to write something that you not only will like, but that you'll actually understand." And every time I see them, I ask her if she's read any of my columns, and if not, I hand my phone to her and give her one. And um, she said, "Oh, I like it." And yeah, I think I might understand it, maybe some of it. And so that's my goal. I'm writing for her, um, because if she can understand it, so can all the readers I want. And, um, I have a lot of professional readers too. I've got a lot of portfolio managers, economists, finance professors, policymakers. I hear from all those people. And sometimes I'm surprised at who does read my column, but I'm trying to bring everybody along. So it's for my high school English teacher's wife.
Now, where'd you go to high school?
I didn't go to high school. I went to a central school, which most of our listeners, it's probably a term a lot of listeners don't even know the meaning of. It was kindergarten through 12th grade under one roof. Um, I grew up in a farming village in northern New York State in Washington County, between Saratoga and Lake George. And there were 600 kids in my school from kindergarten through 12th grade. So it was very small. And, uh, there wasn't much of a transition from middle school, or as we called it, junior high to high school. It was, you were out in the same hallway. You just went to a different room.
Well, I'm not too sure. I believe this was Robert Oppenheimer who said this, but not certain that a scientist who can't explain to a child what they do is a fraud.
Mm,
And I
yeah.
think, yeah, go ahead. I'm sorry.
Yeah. No, just to follow up on that, Frank, what I often advocate a technique that I call the 4 whys, WHY, asking the question why 4 times. So, uh, just to throw out a hypothetical, it's the first thing that pops in my head. If a portfolio manager were to say to me, you know, value stocks are sure to outperform the overall market in the long run, I would say, why? And then and it probably would be a he, would answer something like, well, because they're underappreciated by investors. And I would say, why? And you might pause and say, well, their earnings are lumpier and they're more volatile. And I would say, why? And I've only asked why 3 times. And at this point, I think the person is starting to grasp at straws, because it's like if you really understand something, uh, just like a 4-year-old kid, because that's what 4-year-olds do, right? They
Well,
ask you why 4 times because they're 4. And, I can remember my daughters asking me why the sky was blue. And I think I could deal with 2 whys, but I couldn't even get past the third. And if you really understand something, you can answer why 4 times, and if you don't, you can't.
well, but how do you identify and select the stories you want to write about, especially in such a broad field as personal finance? Do you get people writing to you and suggesting stories?
Well, it's everything. So, yes, absolutely. You know, uh, I've never quantified it, but I would say probably something like 15 to 30% of the columns I write are suggestions from readers. And those people, that could be anybody from an individual investor in, Keokuk, Iowa, to, uh, a portfolio manager who manages billions of dollars, to a finance professor. Um, to somebody who doesn't even identify himself or herself. So a lot of the ideas come from readers. A lot of the ideas come, uh, uh, to paraphrase Shakespeare, they're thrust upon me. Um, Obviously, last week I had to write about what was going on in the financial markets, and I imagine this week I will too. We're speaking right after President Trump instituted his tariffs, and I think uh, it looks a little weird to write about anything else at a time like that. So that's certainly a source of column ideas. And then, the other two are my reading. And, earlier, Frank, when you asked about sort of, habits for success or, whatever success I have had, um, one of the things I should have mentioned is my reading. So uh, I read all kinds of things. I read a lot of academic research. Um, I read a lot of financial history. I read a lot of behavioral economics and cognitive psychology. But I graze, I might read an article about, evolutionary psychology or animal behavior, um, uh, or the history of, Ponzi schemes in Albania, or, you know, um, this weekend I was looking at a book about fools and jesters, like court jesters, um, and Shakespearean fools. And um, it just got me thinking about uh, the difficulty of being a skeptic and the fact that throughout history and across cultures, even in ancient China, um, the most powerful people, like the kings and emperors, usually employed a jester or a fool who could mock them uh, at moments when they had to make really consequential decisions, and, just as the Roman emperors supposedly had someone in the chariot who would whisper in their ear, memento mori, remember that you will die. Um, we all need that skepticism and dose of humility, and um, you need a structure for that. So, you know, wide reading really helps remind me of that, and it's also a source of story ideas.
Are there any particular topics or trends in finance that you feel are underreported or misunderstood by the public?
Um, well, certainly, uh, I have grave concerns about and this is something that, of course, was near and dear to Benjamin Graham's heart, and he wrote about it almost endlessly over the decades. I mean, if there were one thing that I would like to hammer home to my readership and actually get people to accept, it's that there's a difference between investing and speculating, and understanding it is just incredibly vital. And I think that's hugely underappreciated and misunderstood. I think, you know, uh, I can still remember meeting a teenage kid who was a friend of one of my daughters, and she introduced him, and she said, "Oh, Daddy, he invests too." And so I started talking with him, and all he did was this was maybe 10 years ago, was he would trade various cryptocurrencies like hundreds of times a day, every few minutes. Um, and it was his only that and video games were his only hobbies. And I said to him, that's not really investing. And he said, why not? And I couldn't make him understand.
Did he give you the four whys?
Well, well, he, I refrained from asking him for tips on his favorite cryptocurrencies. So,
Well, we won't be talking about crypto. Personally, I don't. I, I have a personal view on that, but with cryptos, I find very interesting that the people who were first in there are now the gurus in this area.
hmm
So what I'm curious about is that little old lady who was the first to go into some of the technology stocks when they came out.
hmm
Should we consider them the gurus also and people we should follow?
yeah,
But
probably not. I mean, I've I've heard from lots of readers, for example, who bought Nvidia, you know, in the early 2000s and held it and kept it, and who are now multimillionaires just because of that one stock. But it's true. I don't think we would regard them necessarily as expert analysts. They made one very shrewd decision and then they left it alone. Um, but do they know any more about NVIDIA than the next person? Probably not. All they know about it is that it really paid off well for them.
what is your process for researching a story, particularly when you're covering really complex and nuanced topics? I mean, you know, uh, if you had a finance degree, let's say an MBA, you might be able to revert back to a book or something like that that you used, although there's so many new concepts being developed. So what's the process? If I was a journalist and I wanted to figure out, I wanted to research a story, how would I go about that, particularly for the type of topics I just mentioned?
Yeah. So, you know, uh, typically what I try to do is um, I try to figure out what is the longest and best available uh, data available on this topic, and what does it tell us? And that usually points me toward high quality academic research, typically almost irrespective of the topic, some academic somewhere or some very good analytical team at a major investment firm has analyzed the historical record and, has figured out, you know, uh, uh, what's the average rate of return on a covered call strategy, or what percentage of people who have tried this particular approach um, have made money doing it. And so that's typically where I start. And then, I'll try to read all the publicly available documents if it's an investment product. Then I'll interview the portfolio manager if, again, it's an investment product. Otherwise, I'll interview whoever the people are who are most relevant to the topic. And, again, one of our guardian principles at the journal is what we call the no surprises rule. So, you know, for example, if I'm writing about something that some of my sources are saying may be fraudulent, um, one of the first things I'll do is I will reach out to the people behind it, and request an interview, and I'll sort of spell out what the concerns are that have been expressed, so that they realize that I may be asking them some tough questions, and they can prepare for that. There's no, we don't bushwhack people. Um, it's not my objective to catch somebody by surprise and try to get some sort of gotcha quote out of them. I want to give them every opportunity to defend themselves and tell their side of the story if there's any doubt about their honesty or legitimacy or authenticity. But, that's not the bulk of my work. I mean, most of the time I'm writing about financial markets, investment strategies, uh, particular approaches. And, most people in the financial industry are at least trying to be honest. Um, so I just want to give them their best opportunity to explain what they're doing and why it's beneficial for investors.
Mm, thank you. Uh, you recently expanded Benjamin Graham's classic, The Intelligent Investor, which is naming your column. And that was published back in 1949. It was about
Hmm.
76 years ago.
Yeah.
Some might some might be telling you the book is obsolete. How can it still be relevant to today's investors? What inspired you to delve into this classic, and what did you hope readers would gain from your new insights?
Yeah. So, in 2002, HarperCollins, which is the publisher of The Intelligent Investor, approached me and asked me if I would think about um, updating Graham's book. And I said, I just did. Because as soon as they asked me, I said, yes, I want to do that. Um, I don't need to think about that. The answer is yes. I mean, I was uh, incredibly like flattered and delighted to and honored to be asked to do it. And you know, for the 2003 edition, which was the first one I revised, and then again for the one that came out in 2024, which is the 75th anniversary edition. Uh, all I was really trying to do was, first of all, to explain a bunch of terms that Graham used that, you know, not everybody around today may fully understand, like, railroad mortgage bonds and things like that. Um, and um, and to annotate his chapters so that, for example, companies' names have changed. Uh, there are terms in there that have gotten kind of obsolete, like income bond. And, not a lot of people today really buy preferred stock anymore. So there was a lot of explanation that I had to do. But then I accompanied each of his chapters with a commentary of my own where I tried to put Graham's ideas in a contemporary context. And um, it was actually quite, uh, it was fun to do. And what I quickly learned from it is what Warren Buffett has said for decades, which is that the value in Graham's work is not in the formulas. Graham is famous for, things like a stock is cheap if the product of its PE and its price to book ratio is less than 22.5. And that's what he wrote in 1972. If he were around today, he wouldn't use that formula. He would have some other formula. And so the people who say, oh, the book is obsolete, they're focusing on sort of the specific details and some of these simple arithmetic rules that Graham spelled out. But what makes the book great, and I would argue makes it even more relevant than it was in 1949 when he first wrote it, is what Warren Buffett has called the emotional framework of the book. And, Graham spells out this handful of wonderful principles. First of all, a stock is not a piece of paper. It's not a ticker symbol. It's not a, flashing pixel on your computer monitor. It's a it's a share in an underlying business. And it will be a good investment if the business produces growing amounts of cash into the future, and it would be a bad investment if it doesn't. Um, and Graham also teaches us the difference between investment and speculation. That, as he put it, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. I mean, it's a very old-fashioned idea, but really all he's saying is you have to do some homework. You can't just buy a stock because you like the ticker or the CEO wore a, a shirt you like on CNBC, or because, or you buy some crypto because all your friends are buying it. You have to research. You have to do actual, like, shoe leather research to decide whether an investment is worth owning. And then Graham also introduces this incredibly brilliant metaphor of Mr. Market. He's like your neighbor. You own a small business, and every day Mr. Market knocks on your door and he says, I want to buy it. Um, and some days he offers you a really high price that's tempting, and maybe you would sell your dry cleaner or your video production company or whatever you might have. But other days he offers you $1 for the entire thing. And of course you wouldn't transact with him, because so much of the time, he's either euphoric or depressed. And if we thought about the stock market and all the financial markets the same way, we would all be better off. So, I mean, those are fabulous principles that Graham outlined in 1949 that I think, are at least as relevant today as they were then, because human nature has not changed and probably never will.
Did you come across any surprising or lesser known insights from his work or philosophy when you were doing research for the book?
Yeah, there certainly there are a couple, I guess. Um, the most important lesson that I took away from Graham that I do think is underappreciated is, and he wrote about this a lot. He wrote about it a lot during the Great Depression, actually. But Graham argued, he had a point that was really subtle and complicated. He said that the better a business is at operations, the worse it is likely to become at finance. And it's a it sounds like a complicated idea, but it's actually very simple. What he's saying is, uh, the greater a business is at selling goods and services that customers love, and the more profitable it becomes, uh, the more cash it's going to pile up, because it's going to generate far greater profit than it can reinvest in its own businesses. And at that point, a conflict of interest arises between the management and the investors. Because, as Graham put it, the management will always run the company with more capital than it needs, because it makes the managers feel safer. They have a cushion. And the cash really belongs to the shareholders. And management is going to be reluctant to share it in the form of dividends or even share buybacks, uh, because they're always going to be saving for a rainy day. And I mean, think of a company like Apple or Google, I mean, they've got tens of billions of dollars of cash that they're just sitting on. Or for that matter, think of Berkshire Hathaway, you know, with hundreds of billions of dollars of cash. And very few investors, I think, understand this because people have an instinctive tendency to view cash as safe, which of course it usually is. Um, but when a company is just sitting on it, you might as well have it because then you could do what you chose to do with it instead of having it sit idle. So I think that's the most surprising thing that I learned from Graham.
A lot of that, the implications of Michael Jensen's principal agency theory
Yep.
actually follow through that. And one implication is that managers with that extra cash will invest in projects that are not really that profitable.
Yeah.
Okay. And they make that mistake. Um,
Exactly. Exactly. Frank, if you think about it in that literature, the principal agent literature, there's the two big problems that researchers talk about: tunneling and empire building, right? And if I remember right, and you'll correct me if I'm wrong, I mean, tunneling is just, they just like let the cash pile up, pile up, pile up. But empire building is the money is just burning a hole in their pocket. And, you think about like back in the 1970s when Exxon got into the typewriter business, or in the late 90s when Amazon bought a whole bunch of other dot-com companies, most of which ended up going bust. When management has more capital than it can possibly employ profitably in its own businesses, then you get a risk that they'll employ it unprofitably in other businesses. Or, of course, mergers and acquisitions that might not pay off.
what advice would you give young journalists or aspiring writers who hope to follow in your footsteps?
Well, I guess the first would be think twice. Uh, uh, journalism as a field overall is contracting. That might not persist indefinitely, but it's certainly the case now. As I look around the Wall Street Journal newsroom, I see tons of people in their 20s and 30s. So young people are obviously not discouraged um, by the belief that journalism is somehow dwindling. But, I would think twice. There may be other things you can do with the skills you have. Good communicators are in demand in just about every field, including finance, where they're in very high demand. Um, but I think the main thing I would advise young people to do is, indulge your curiosity. Um, have no shame about asking stupid questions. We were talking before about the importance of the fool. Um, I often ask questions that might make me seem like a fool, but I don't feel like one. I'm actually quite proud to tell people I know nothing about the topic, um, because I know I'm being honest. Uh, and uh, there's two other things that I think are important, which are persistence. Just not giving up. Don't take no for an answer. Don't tell yourself no. Um, and then the other, of course, is accuracy. I mean, it's just incredibly important to get the facts right and to practice that in everything you write and everything you communicate.
Are, are you, well, I don't know if you're interested in sports, but if so, do you ever find parallels between sports and financial topics. Have you seen ways in which sports reporting intersects with financial journalism?
Oh yeah, all the time. You know, I mean, back in the 90s, and to some extent it still persists today, there was a real tendency to write about investing as if it were a pennant race. Um, it was the S&P 500 versus every active fund manager, and it was sort of like, oh, Will Danoff is ahead. No, now he's behind. Oh, Bill Miller's pulling out in front. No, here comes the S&P. And, that sort of horse race or pennant race mentality, it makes coverage exciting, I guess, at least for the writers and editors. Whether readers see through that, I'm not totally sure. But certainly, we see that today in like almost like a weaponized format. I mean, if you think about trading apps like Robinhood, for example, um, you know, when you when you open most trading apps, you're going to see a display on your phone that looks like a race. It's going to show how your investment or how the market or how some particular asset is doing against some particular benchmark, and it's going to show it to you in real time. And it's it's kind it, the way I think about it is sort of like, I guess I guess in New England, there are still some dog tracks, right? Do you know about this, Frank? Where they do where greyhounds race, um, kind of like a horse race, and, there's a rabbit. They chase a rabbit. I think it's a mechanical rabbit, and so all the dogs are, like, sprinting at top speed. I mean, can a greyhound run what, like 30 or 40 miles an hour probably for a sprint? So they're going 30 or 40 miles an hour around the track chasing this mechanical rabbit. And when you open that app on your phone, that's kind of what you see. You just see this like green or red blip that's like moving in real time. And what I wish people would understand is you're not watching the dog chasing the rabbit. You're the rabbit. You're the rabbit. The market is chasing you, and, this trading app is trying to get you to make as many trades as possible so the firm that owns the app can make money off you.
Okay, I enjoy that. Last question. You said you do a lot of reading of various journals, both academic and practitioner, looking for ideas. Did you ever wonder why people who publish in some of these journals strategies that they have and say, well, that's interesting. Why would they ever want to tell anyone about that? And really, why not exploit it themselves with the leverage opportunities that are available?
Yes, and, I wonder that all the time, and in fact, the whenever I'm interviewing an academic who has discovered, an anomaly in the market, or as I guess we like to call them now, factors or smart beta techniques. Um, the last question I always ask is, are you doing this with your own portfolio? And you would be surprised at how often people say, no, I'm not.
Well,
And
sometimes it's difficult to do.
yes,
On that
correct.
front, yeah.
Right. Exactly. And the usual reason for why they're not doing it, well, there's two things come up. One is uh, risk. I think it's too risky. I'm investing my family's money. I don't want to take that level of risk. And then the other that comes up almost as often is implementation cost. It's like, yes, this this works, but once if I have to pay my broker to do it, then it's not going to work. And then, of course, the obvious follow-up question is, why didn't you say that in your article? Um, and the answer is, oh, well, we're just demonstrating the empirical finding, like in the absence of real-world friction. Um, and one of the most common threads in the columns I've written over the years, the more than 750, is, what works in theory often does not work in practice because translating a theory into practice is expensive. You have brokerage costs, you have uh, execution error from time to time, you have taxes, um, and of course, the return has to be net of inflation. And once you factor all those frictions in, often after the friction, you know, sometimes all you're left with is fiction. I mean, it does happen.
Well, listen, this has been wonderful. Time has flown on this, and
Yeah.
uh, I mean, my great takeaway is the four whys. So I'm going to
Yes.
be using those frequently. But thank you very much, and good luck on your future writings. And
Hmm.
I'm sure both financial professionals and journalists are going to get take away a lot from this conversation. Thank you
Oh,
very much.
well, thanks for having me, Frank. It was a blast.